Hi members, and welcome to another Macro Monday. My name is Mitchell Snedden, and of course I'm joined by Callum Pickering. Callum, let's get right into it. We'll wrap up last week. On Friday we had the stability review come out. What did it have to say?
Yeah, so the Reserve Bank released their financial stability review on Friday. It comes out every 6 months or so. It gives us some insight into what's happening with financial stability issues. Now, their big focus this time was on the apartment sector. So looking at apartment construction, what that means both with regards to households, so with their lending activity, but also on the side of developers. Are they overstretched? Is there some concerns there? Now, there are mounting concerns about the oversupply issue, and there's a lot of supply still in the pipeline. So there is a genuine risk that we could build more apartments than we genuinely need. And when that happens, you typically see a very large decline in apartment prices, which seems to be a view that's gaining some popularity at the moment.
Going to say, why is there an
Why was there an oversupply?
Yeah, is it because our interest rates, low interest rates, driving that? Or is it selling the whole idea of flogging apartments to Chinese investors?
No, there's a range of things that I would say. So I'd look at, first of all, you got obviously low interest rates drove house prices a lot higher. When prices are high, you tend to see more investment because there's profits to be made. And that's what you've seen here. But what you also tend to see is there's usually an overinvestment because they don't factor in the fact that prices are likely to fall. And a good example of that was the mining sector, with all the investment that went on there when commodity prices were very high. And then by the time that investment was completed, prices had declined.
And so looking forward to this week, we've got Philip Lowe fronting for another speech, and we also have the RBA board minutes coming out as well. What are we expecting to hear from Philip and see from the minutes?
So the speech and the minutes come out on Tuesday. Philip Lowe's talking in the morning before the minutes come out. He's talking on inflation and monetary policy. So there's a bit of a double up in the topic there. So it's going to be interesting to see what Philip Lowe has to say. It's only his second official speech as RBA governor. It gives him the opportunity to go a little bit more in depth into what's happening with inflation. And the September quarter inflation figures are released next week, but also what that means for monetary policy and how he sees things developing over the next 12 to 18 months.
And now wrapping up just at home here, on Thursday we also have the labour force figures. What are you expecting to see from these? The
market currently expects a result of around 15,000, which is a little bit stronger than we've seen with the monthly trend over the past 6 months or so. So it's a pretty solid result given where the economy is currently. Now, the market also expects the unemployment rate to increase to 5.7% from 5.6% a month earlier. From my perspective, I'm more interested in the part-time, full-time split. What we have seen over the past 12 months is that employment has been driven almost entirely by part-time employment, which means that 15,000 jobs created right now isn't quite the same as 15,000 jobs created 5 years ago or 10 years ago. So that's something that we definitely need to keep an eye on.
Now, going over to the US, Janet Yellen had an interesting speech the other day where she used the phrase, the Fed should start a high-pressure economy. What does that mean?
So a high-pressure economy is basically this idea that the Federal Reserve is going to keep interest rates lower for longer. And what that's going to do is it's going to drive the unemployment rate down to a level that is sufficient to foster increased inflation. So when Janet Yellen talks about this, she's actually suggesting that the Fed may be willing to tolerate higher inflation than their annual target of 2%. So in theory, you could see inflation increase to, say, 3% without the Federal Reserve reacting by increasing interest rates. Now, the whole idea behind this is so that they lift potential economic growth. Because what Janet Yellen noted was that in the aftermath of the global financial crisis, the long-term trajectory of the US economy was fundamentally changed to a much lower level. And what she's suggesting is that perhaps if they keep interest rates at a very low level for a long time, it might be sufficient to change that so that the long-term trajectory of the US economy is higher than it currently is.
Excellent. Well, Callum, thanks for joining us again. And members, thank you for joining us, and we'll catch you next time on Macro Monday.